Welcome to The Interest. I'm Ryan Kingsley. This Tuesday, we're joined by Shane Kidwell in a new segment of Tech Talk. After that, stay tuned for a new episode of Road to Riches with our friend Steve Richman. But before we hear from Shane and Steve, a story. The word redlining and the practice itself of avoiding extending access to mortgage credit in certain neighborhoods due to the racial composition of those areas, which dates back a century, stems from the literal practice of drawing red lines around such areas on maps. In October 2021, U.S. Attorney General Merrick Garland launched the Department of Justice's Combating Redlining Initiative, a renewed emphasis on identifying and tackling this kind of discriminatory lending. However, to do so, the government is using a modern theory of redlining that industry experts call untenable, and making demands of lenders that those experts also call unconstitutional. Here's the story. Paul Hancock is a civil rights attorney who spent more than 20 years in senior roles at the Department of Justice, developing and implementing the government's fair lending enforcement programs. In fact, he helped bring forward the government's very first case of redlining against the Atlanta, Georgia-based Decatur Savings and Loan Association. When it comes to current investigations and cases regulators are bringing forward in redlining, he says,
sometimes I'm blamed for some of this, but I think that this has gone really pretty far away from where we started.
Why is that?
My concern is that the government has kind of drifted much closer to a demand for racial balance in loan originations rather than attacking lenders that really are refusing to do business in minority areas. And in a nutshell, their basis for bringing these kind of claims is to look at the proportion of a lender's loans that are in minority neighborhoods as compared to proportion of other lenders' loans in minority neighborhoods.
By pursuing this theory, regulators risk making fair lending enforcement and lenders' fair lending compliance a data exercise.
Under the government's theory, you can eliminate redlining by just making fewer loans in white areas. You're not doing any more in minority areas. You're making fewer loans in white areas, and somehow that solves your legal problem. That just doesn't make any sense.
Steve Simpson is the director of separation of powers litigation for the Pacific Legal Foundation. He helped represent the Chicago-based independent mortgage lender Townstone Financial in its redlining case against the CFPB, which is currently on appeal.
The problem arises when they start inferring discrimination from statistics when they don't have direct evidence of discrimination.
Which means, instead of punishing lenders who are actively discriminating against borrowers,
you end up trying to compel mortgage companies or businesses to lend on the basis of race and on the basis of other factors that they're not supposed to take into consideration.
Ultimately, compelling mortgage companies to achieve a racial balance in their loan originations violates the Constitution. Now, redlining was banned in the 1977 Community Reinvestment Act, or CRA, which also instituted a framework for assessing lenders' compliance with the law. This used to only apply to depository lenders, not independent mortgage banks, or IMBs, because IMBs don't take deposited funds out of communities. They import credit in. Only recently have a few states passed state-level CRA laws that also assess IMBs under a data-driven theory of discrimination, Illinois being the most recent state to do so. Taking effect this past January, the problem is
the Illinois mortgage bankers gave comments, as suggestions on where this law wasn't necessarily fair to everyone. And then it didn't even get voted on. So then it came back to the floor in January, and the comments that I'm going to cover here in a second that have been submitted were kind of ignored.
The ignored concerns echoed those of industry experts worried that IMBs are being unfairly accused of discriminatory lending. At the end of the day, most lenders facing redlining lawsuits from the U.S. government don't have the means or wherewithal to litigate.
There's no question about it that banks and lenders who have been sued have chosen not to litigate against the government, even though they thought the government was wrong in its legal theory and its factual analysis of the case.
As for what this means going forward,
at some point, the industry needs to push back more on what's been being demanded here to try and get some balance and fairness to application of the civil rights laws.
To learn more about how data drives regulators' modern theory of redlining, putting lenders in a constitutional bind, visit nationalmortgageprofessional.com. For The Interest, I'm Ryan Kingsley.
We all dream of owning a home, but for too long, if you didn't fit the mold, you were stuck. Stuck because the system worked for everyone except you. We've changed that. Angel AI uses advanced AI technology to give a 100% trusted solution and fast answers for worry-free financing, allowing you to achieve fair and equal access to lending. Angel AI. AI you can bank on.
Hey everybody, it's Shane Kidwell back with another technology tip of the week. And this time I brought on a good friend of mine and one of the contributors with myself at Next Level, Sean Richards. Sean, what is a technology that you can't live without?
Hey Shane, great to be here. I would say my number one technology that I can't live without in my business is Calendly. And so, for those of you who don't know what Calendly is, it's really a scheduling tool that allows you to be extra vigilant with your calendar. It allows you to provide clients with scheduling portals. For me, I love the ability to have control over my schedule while at the same time giving real estate agents and clients the illusion that they have control over my schedule. And that's kind of what I love most about it, because everyone wants control. And so if I can give them the illusion that they're in control of selecting times, selecting dates, but they're all predetermined by the times and dates that I've made available, it works for both parties and allows me to really nail down my schedule and stick to the times that I want to set aside for those types of calls.
I love it, man. So it's strategic, it saves you time, and it gives your audience the illusion of control, and in some cases, actual control. And there's, I think, nothing more important than that for consumers and real estate agents in this market. Guys, we'll see you next week for another tech tip. Thanks for checking in.
Here's a mistake I think a lot of loan originators make. They make it all about themselves and they look at other LOs as the competition. Actually, you should get to know other loan officers. Why? You can learn from other loan officers. You can pick up best practices from other loan officers. You can grow your network with other loan officers. And who knows, if they don't have that loan program where they work, they might refer that person over to you. Get to know other loan originators.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.